Standard historical income statements carry a severe limitation for management. They are entirely backward-looking. They only record what has already happened on the factory floor. To plan new projects effectively, management teams require tools that look forward, not backward. Operational survival dictates that a company must know the absolute minimum required sales to cover its costs before a single machine is turned on. The solution to this problem is cost volume profit, or CVP analysis. CVP models the exact mathematical relationship between three distinct elements: variable costs, fixed costs, and total sales volume. By isolating these inputs, managers use the CVP framework to simulate how a change in any one of these specific variables will alter total operating expenses. Calculating these variable interactions allows companies to accurately predict their final net income under multiple different production scenarios. Slight pause for emphasis. CVP analysis shifts management from merely reading historical financial records to mathematically simulating future operational outcomes. To build a predictive CVP model, every single operational expense a company incurs must first be divided into one of two strict categories. The very first category is variable costs. The defining trait of a variable cost is that its total amount changes directly with the overall activity level of the business. This change is strictly proportionate to the actual number of products being produced. If production goes up 10%, the total variable cost goes up exactly 10%. A tangible production example is direct material. The physical steel, plastic, or silicon required to build a product is a variable cost. On the labor side, direct labor hours are also variable costs, as they scale directly with the time spent actively assembling units. The second required category is fixed costs. Unlike variable costs, fixed costs do not vary at all, regardless of any changes in the activity level. Common physical overhead examples include facility rent, utility bills, and property insurance. These bills arrive whether the factory runs at maximum capacity or sits completely idle. Administrative overhead also falls into this category. Employee salaries and corporate advertising budgets are fixed costs. The accurate classification of these expenses is the absolute bedrock of CVP. If a fixed cost is misclassified as a variable cost, the entire predictive model fails. The mathematical elegance of CVP relies entirely on operating within strict boundary conditions. There are 5 core assumptions required for the model to work. Assumption 1. The behavior of both costs and revenues is perfectly linear. This linearity is only assumed to hold true throughout a specific relevant range of the activity index, meaning the company's normal expected operating capacity. Assumption 2. Every single cost can be classified accurately as either strictly variable or strictly fixed. There is no gray area. Assumption 3. Changes in the activity level are the only factors that affect costs. Outside economic variables are ignored. Assumption 4. To maintain the equation's balance, the model assumes no inventory buildup. Every single unit produced is completely sold. Assumption 5. When a company sells more than one type of product, the sales mix, the proportion of different products sold, is assumed to remain perfectly constant. While these 5 rigorous assumptions appear restrictive, they are precisely what isolate the internal variables and allow managers to trust the mathematical output. Once costs are classified, we can examine the central mechanism that powers all CVP calculations, the contribution margin.
Conceptually, the contribution margin is the revenue remaining from a sale after all variable expenses have been entirely deducted. In this diagram, we can see this expressed algebraically. Unit selling price minus the variable cost per unit leaves us with the contribution margin per unit. To find the macro impact, we calculate total contribution margin. This equals the contribution margin per unit multiplied by the total sales volume. There is a strict operational sequence for how this remaining money is utilized by the business. First, the contribution margin is used exclusively to pay down the company's fixed costs. Only after all fixed costs are completely neutralized does any remaining margin convert into actual profit. We can also express this as a percentage using the contribution margin ratio, which is calculated by dividing the contribution margin per unit by the sales price per unit.
The contribution margin is a mathematical lever management uses to offset structural overhead. We can transition from unit economics to total operational scale to pinpoint the exact moment a company stops losing money. This is the break-even point. Measured in units, it is the precise number of products a company must sell to cover all production costs. Measured in dollars, the break-even point is the exact amount of sales revenue required to cover both total variable and total fixed costs. We can visualize this on a Cartesian plane. Here is the unmoving baseline of our total fixed cost. Next, we plot the total cost trajectory. Notice it slopes upward starting from the fixed cost baseline, driven entirely by the addition of variable costs. Finally, we plot the total revenue trajectory, which starts at 0 and slopes upward to eventually intersect the total cost line. At this exact intersection point, total cost equals total revenue. Net profit is exactly 0. To find this break-even point in units mathematically, you divide the total fixed cost by the contribution margin per unit. Alternatively, to find the break-even point in sales amount, you divide the total fixed cost by the contribution margin ratio. Breaking even is a milestone, but running a business requires generating profit. Management uses CVP to set a specific income objective, known in accounting as target net income. The required sales formula adapts easily. We simply add our target net income to the total fixed cost in the numerator. This single calculation proves exactly what sales volume is mathematically required to justify a project's existence and achieve strategic goals. Once profitability targets are projected, management must calculate their risk exposure in the event that actual sales underperform. The final managerial metric used to quantify this operational risk is the margin of safety. Conceptually, the margin of safety measures how far sales could fall before the company begins operating at a loss. On this expanded graph, we see the mathematical definition: expected or actual sales minus break-even sales. Let's apply specific case data. We will plot a company's actual sales at $1.2 million. The corresponding break-even point for this specific operation is $960,000. Calculating the difference reveals a margin of safety of $240,000. We convert this to a margin of safety ratio by dividing that margin by the actual sales, yielding 20.